Medium and long-dated treasuries keep going up and up, even with a bad jobs report. What could go wrong this coming week? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Here are the 3 topics that we'll be covering in today's update video. 1. Why might treasury yields come crashing down after the election? 2. Which treasuries fell this past week already, and which ones continue to move upwards? And 3. What are the expectations for the upcoming week's 3, 10, and 30-year treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. As our Diamond NestEgg regulars have heard me say often in recent weeks, medium and longer term treasury yields have been going through a good season lately. This week, the 10-year yield hit a 4-month high, and the 20-year and 30-year yields surged 10 basis points on just Friday alone. The primary drivers include continuing caution from the Fed about a slower pace for future rate cuts, growing belief in a soft landing, and ongoing election uncertainty. Elections tend to have little impact on markets over the long run, but in the near term, they do impact markets, as we are seeing with the recent uptick in bond yields as we get closer to Election Day. And while some of the polls show a relatively tight race, depending on which website we're looking at and when we're looking, the folks that are putting their money where their mouth is, so to speak, namely these betting sites here, show much bigger betting odds on a Trump win than a Harris win. But it's not just betting sites. It seems that quite a number of market experts are also currently working with the assumption of a Trump win. According to Michael Schumacher, the global head of macro strategy at Wells Fargo, not the former racing driver Michael Schumacher, for those of you who are into Formula One racing. So, according to Wells Fargo's Michael Schumacher in this recent CNBC TV interview, which I've linked below for your convenience, the bond market is pricing the Trump trade pretty clearly, meaning the market expects a Trump win. Despite Trump's position on tariffs and some other matters, he is the presidential candidate that markets seem to view as overall more business and economy friendly, meaning that under Trump, the markets expect the likelihood of a soft landing to be higher than under Harris. Or, to put it another way, they see the likelihood of a recession lower with Trump versus with Harris. And the lower the likelihood of a recession, the less likely that rates will come down fast along the entire maturity spectrum. And it's not just bonds. In a recent survey conducted by Bloomberg, which included 350 market participants, nearly 40% expected the S&P 500 to accelerate under Trump, whereas less than half that number expected the S&P 500 to accelerate under Harris. What this means is, again, in the words of Wells Fargo's Michael Schumacher, if Harris does win, yields come down pretty substantially. 1, because the election uncertainty, the uncertainty premium, will go away. And 2, because the likelihood of a soft landing situation may be slightly lower and faster rate cuts may become more likely. Now, if you're a Diamond NestEgg regular who is dollar cost averaging on an ongoing basis into your fixed income portfolio, which is something we often recommend, this doesn't really mean much to you. That's the whole point of dollar cost averaging, to spread your price risk, so that on average, you're fine, no matter which direction the market goes or who wins the election. If you're a Diamond NestEgg regular who's still waiting for yields to go higher and higher before you buy, then the election outcome may matter to you, and a Harris win may foil those plans in the coming weeks, given current market expectations and pricing in of a Trump win. And if you're a Diamond NestEgg regular who trades bonds often, who doesn't really look at long-term yields to maturity, but rather current bond prices and how much you think they will go up or down even in the short run, you may, as I've said before, want to sit tight until there is a bit more certainty after Election Day. And who knows, right? Depending on how things go on Election Day and whether there is a clear winner, this uncertainty may even drag on for a few days longer, which will also surely cause more market volatility overall. So, with that in mind, let's move on now to the next section of today's video. As we so often do at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Overall, the yield curve continued to uninvert at the extreme ends, reflecting the view that the market seems to be increasingly pricing in the likelihood of a successful soft landing, as I just discussed before. The spread between the yield on the 1 month and the 30-year is still in negative territory, meaning the 1 month still pays more than the 30-year. But the difference has come down substantially this last week, from 38 basis points to 18 basis points only. Compared to the previous week, yields were up across all maturities 2-year and higher, with the 5-year and the 7-year T-notes making the biggest moves at 15 basis points each. And as I mentioned earlier, the 10-year T-note hit its highest level in 4 months this week. On the shorter end, everything 1 year and below was down, with the 1 month and 4 month T-bills down the most. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across all maturities 2-year and below are still noticeably lower than where they were at the start of the year, although the difference has narrowed quite a bit this past week again for the 2-year. And the 3-year has now joined the ranks of the longer dated Treasuries with yields that are above where they were on January 2nd of this year. And as discussed earlier, with short end yields down and long end yields up versus the beginning of the year, we can see the yield curve continuing to steepen here as well at the extreme ends. The difference between the 1 month versus the 30-year has shrunk to just 18 basis points from 147 basis points from the beginning of this year. And remember that the widely used comparison of the 2-year versus the 10-year Treasury has been in positive territory for a bit now. Let's spice this section up with a question. When do you think the yield curve on the extreme ends will uninvert? Meaning, when do you think that the 1 month will finally pay less than the 30-year? This month? Next month? In 2025? Or after 2025? Drop a comment below and let the community know. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker or when you sell will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon still remains to be determined on auction day. At the time of this taping, here's what the coupon and the expected yield are for the 3-year T-note auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one at 5.75% from FHLB, with a first call date in February 2025. For corporate bonds, there's a slightly smaller list than last week, but here's where the highest yielding new issues stand at the moment. And once again, the highest yielding one is from Deutsche Bank at 6.05%, with a first call date of November 2025. If you're interested in brokered CDs, here's where the new issues are currently. There are quite a lot of them that are yielding 4.5%, as you can see. For bank CDs, and for those of you specifically with Capital One, you should know that they are also offering 4.5% as a special CD rate for an 11-month CD at the time of this taping. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our 2024 Bond Courses. Or come join our next live member Q&A on Sunday, November 24th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into all things fixed income. I've also linked all the details on our Bond Courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.